Why stock market crashes happen. A stock market crash is usually defined as a sudden drop of at least 20% or more in a short period of time. Crashes are caused by major shocks, economic recessions, inflation spikes, high interest rates, wars, global instability, or even pandemics. For instance, in 1929, the Great Depression wiped out nearly 90% of stock market value. The dot-com bubble of the early 2000s saw tech companies with no profits collapse after years of hype. In 2008, the housing crisis and banking failures caused the market to lose half its value. And in 2020, the COVID-19 pandemic caused the fastest crash ever, with the S&P 500 plunging 34% in just a single month. But here's the thing, the reason markets crash so violently is not just the event itself. It's human psychology. When investors see prices falling, they panic and sell, which only accelerates the drop. The market becomes a self-fulfilling cycle of fear. Yet if you zoom out, history shows us that every single crash has eventually been followed by recovery and growth. Why you shouldn't panic. It's natural to feel fear when you see your investments shrinking, but selling in a panic is the worst possible move. If you look at the long-term history of the S&P 500, it has averaged roughly 10% annual returns over the last century. That's despite going through 2 world wars, the Cold War, the oil crisis, terrorist attacks, the Great Recession, and a global pandemic. Imagine this. If you had invested $10,000 in the S&P 500 back in 1980 and simply left it alone, it would be worth over $1 million today. The lesson is simple. Markets recover, but only if you stay invested. When you panic and sell, you lock in your losses. But if you hold, you give your portfolio time to recover. Legendary investor Warren Buffett says it best, "Be fearful when others are greedy, and greedy when others are fearful." This mindset separates the people who lose during crashes from the ones who get rich. Crashes create buying opportunities. Think of a stock market crash as a massive clearance sale. Most people treat it like a disaster, but savvy investors see it as the moment to buy assets at a discount. Take Amazon as an example. In 1999, during the dot-com boom, its stock was trading at $107. After the crash, it fell all the way to $6. Investors who had the courage to buy during that crash eventually watched their shares soar into the thousands. The same pattern happened in 2008. Stocks of powerful companies like Apple, Microsoft, and Netflix were slashed by 50% or more. Those who bought in during the panic enjoyed explosive growth in the years that followed. Netflix, for example, was under $5 a share in 2008. Today, it trades in the hundreds. Crashes are scary, but they also hand you opportunities to buy the best companies at their cheapest prices. The psychology of fear and greed. The stock market is essentially a mirror of human behavior. Fear and greed drive most decisions. During a crash, fear dominates. People sell not because they want to, but because they're terrified of losing everything. On the other side, greed drives people to buy at market peaks, often when stocks are overvalued. This is why the average investor underperforms the market. They buy high and sell low. Successful investors flip this behavior on its head. They stay calm during the worst downturns, and they don't get swept up in hype when everyone else is euphoric. A crash is like walking into your favorite store and finding everything on sale at 50% off. But instead of celebrating, most people run out of the store screaming. If you want to build wealth, you need to treat a crash like a sale, not an apocalypse. Real-life examples of getting rich. After a crash, history is full of investors who built fortunes during crashes. In 2008, when the financial world was melting down, Warren Buffett invested $5 billion into Goldman Sachs. People thought he was crazy, but that deal earned him billions in profit when the bank recovered. Even earlier, in 1939 at the start of World War II, John Templeton invested in every U.S. stock trading under $1. Almost all of them rose in value as the economy recovered, making him one of the greatest investors of all time. More recently, during the COVID crash of 2020, Tesla's stock dropped to around $70 per share. Within a year, it was over $700. Investors who bought during the panic multiplied their money tenfold. These stories prove that market crashes aren't the end of wealth, they're the beginning. Strategies to get rich during a crash. So, how do you actually take advantage of a crash? First, use dollar-cost averaging. This means investing a set amount regularly, regardless of whether the market is up or down. Over time, this lets you buy more shares when prices are low, which lowers your overall cost. Second, focus on strong companies with proven track records. Apple, Microsoft, Google, businesses that will survive downturns. Third, diversify. Don't put all your money into one stock or one sector. Spread your investments so that even if one area struggles, others hold strong. Fourth, hold for the long term. The market is unpredictable in the short term, but reliable in the long run. Finally, keep cash reserves ready. Having dry powder lets you scoop up deals when the market drops. Lessons from past crashes. Each crash leaves us with lessons. The Great Depression taught us about the dangers of speculation and debt. The dot-com crash showed us that hype without real business value always collapses. The 2008 financial crisis taught us about the risks of leverage and risky lending. And the 2020 pandemic crash reminded us that markets can recover faster than anyone expects. Each event was painful in the moment, but every single one was temporary. What's permanent is the upward trend of innovation, business growth, and human progress. Practical steps for investors. Today, if you're worried about the next crash, there are concrete steps you can take. First, don't obsessively check your portfolio. Watching every dip fuels panic. Second, stick to your plan. If your goal is long-term growth, don't abandon it when fear sets in. Third, consider investing in index funds or ETFs, which spread your risk across hundreds of companies. Fourth, educate yourself by reading about past crashes so you'll recognize they are normal, not unusual. And most importantly, think in decades, not days. If you don't need your money tomorrow, the crash won't matter in the long run. The wealth transfer. During crashes, most people don't realize that market crashes are massive wealth transfers. Impatient investors sell low, while patient investors buy cheap. Over time, the patient ones build wealth, and the panicked ones lose. That's why many billionaires and financial legends credit market crashes as the pivotal moments in their careers. In simple terms, crashes move money from the scared to the calm, from the short-term thinker to the long-term investor. Final mindset shift. Instead of dreading the next crash, start preparing for it. Save some cash, have a watch list of strong companies, and keep your emotions in check. If you view crashes as opportunities instead of disasters, you'll separate yourself from the majority of investors. Remember, the stock market has always recovered, and those who stayed invested always came out ahead. A crash isn't a signal to run, it's a signal to buy. Thanks for watching. If this breakdown gave you a new perspective on investing, make sure to like, share, and subscribe for more financial wisdom. And remember, don't just survive the next crash, use it to thrive.